Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N. Raja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. Let's get started. Here also I'm going to use a balance sheet, and on the left hand side I've just mentioned as liabilities, but it is equity and liabilities. Okay, now listen. This business has raised 100 million from shareholders. From bank it has raised 100 million, debentures 100 million, and from sundry creditors 200 million. It means totally this business has raised 500 million. Now let us not look at the asset side because our focus is on the debt equity, that is outside liabilities and equity. So what we have to do now is we have to compare the debt with equity. So what is equity? Equity is basically the owner's money, which is 100 million, and debt in this case, that is outsiders money, bank loan, debentures, sundry creditors, all three put together is debt 400 million. And we have to relate these two so that we can calculate debt equity ratio. Let's do that. Debt is 400 million, equity is 100 million, and debt equity ratio is debt by equity 400 by 100, and we get the value as 4. But I'm going to express that as 4:1. I'll take you through 3 scenarios once again here so that we can understand it better. Scenario 1, we have already calculated outside liabilities is 400 and owner's contribution equity is 100, and debt equity is 400 by 100, and we get it as 4, and I'm expressing it as 4:1. It means for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. I repeat, for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. That is, if this business is raising 5 rupees, of which outsiders are contributing, look, outsiders share, outsiders are contributing 4 out of 5, that is 80%, and owners are contributing 1 out of 5, that is 20%. They are contributing only 20%, and remaining 80% have come from owners, have come from outsiders. And I see this as a highly risky proposition because this business has too much of outsiders funds, and none of the funds would have come free. All funds raised in the business will have cost, whether it is raised from the owners or from outsiders. If it is raised from the bank, they are going to expect interest. They are going to expect repayment. If it is raised from the supplier, he will load that cost in his product. So this 80% is actually attracting more fixed cost for this business. And if for some or the other reason, if the sales of the business is going to come down because of the market volatility or fluctuation or a recessionary condition like what we are facing or going through now, this business will be in serious trouble because its sales graph will be coming down, whereas fixed cost will remain fixed. So after some point of time, this business will start reporting losses because fixed cost is same fixed, but sales are coming down, sales are going south. Okay, that's why I see this as a highly risky scenario. But let's look at scenario 2. I'm going to take the same total funds of 500, but I'm just changing the proposition. I'm just changing the proportion. I'm saying total outside liability is 333 and equity is 167, and if I calculate debt equity ratio, it is 2:1. 333 by 167 gives 2:1. It means if 1 rupee is contributed by the owner, this business is borrowing 2 rupees. So put together, if this business is raising 3 rupees money, of which 2 rupees, that is 2 out of 3, 2/3 is contributed by outsiders, and 1 out of 3, 1/3 is contributed by the owners. And for me, this scenario is much better than the first scenario, because here the outsider shares have come down. Okay, it means the fixed cost for the business will come down. The financial risk is coming down. And owners are contributing more. In scenario 1, owners contributed only 20%, but here owners are contributing 33%. When owners will contribute more? Only when they have more confidence in their business. I'll take you through scenario 3, where total outside liabilities is 250 and equity is also 250, so it's equal, and if I calculate the debt equity ratio, 250 by 250, I get it as 1:1. So if this business is raising 2 rupees, of which 1 rupee is coming from outsiders and 1 rupee is coming from owners. So this is the best, because the financial risk is also lesser here. Okay, and owner share is more. It means they understand the business, that's why they are investing more. They see this as a promising business, that's why they are investing more, so that they can have more returns out of that. Whereas outsider share also has come down drastically, so fixed cost will also be lesser. So the indication is scenario 1 has high level of financial risk, scenario 2 is ideal, and scenario 3 I would say the best. The debt equity ratio what we have calculated now is very simple, but in reality there will be some more complications attached to it, because it's possible that what we see as owner's money may not be available. It could have gone out of business. And what we see as owner's money may not be actual owner's money also. Let me give you a scenario so that you can understand it better. So this is one sample balance sheet I'm using. Look, there are shareholder funds 200, bank loan 100, debentures 50, sundry creditors 150, so total is 500. And on the asset side you have current assets 250, fixed assets 150, investment in subsidiary 50, goodwill 50, so total is 500. Now with this balance sheet, let's first calculate our debt equity in the normal way, like what we did earlier. So what we have to do, we have to find out what are shareholders funds, and in this case it is pretty straightforward, 200. Then we have to compare that with the debt, which is outside liability. So bank loan of 100, debentures of 50, and sundry creditors of 150. And what is the total? Total outside liabilities is 300. So debt equity we can calculate debt divided by equity, or total outside liability by net worth. Okay, 300 by 200 will give us debt equity ratio as 1.5:1. It means for every 1 rupee contributed by the owner, this business is borrowing 1.5 rupees. And the maximum debt equity for a business can be like 3:1. Okay, just before I said 4:1 is highly risky for a business because 80% debt. So 3:1 means 3 out of 4, 75% can be the maximum debt. It means there should be 25% contribution. And now if you look at this ratio, it is 1.5:1. It means if this business is raising 2 rupees 50 paise, of which 1 rupee 50 paise is coming from outsiders, it means outsiders are contributing 60% and owners are contributing 40%. So this looks like an amazing or wonderful ratio. Okay, but now I'm going to supply some additional information. One is this shareholder funds of 200 million includes a revaluation reserve of 50 million. Includes revaluation reserve of 50 million. Okay, now comes our first headache. This revaluation reserve, or the reserves which are created when assets are revalued to match with the market condition or to match with the market value. Let's say, for example, this fixed asset of 150 includes some land, building and all. In that they had some land worth 10 million. Okay, they had land worth 10 million. I'm just narrating the story before doing the revaluation. Okay, so let me give you the breakup. This 150 has two components, 100 million plus 50 million. What is that 50 million? That's what I'm explaining. This 100 million worth of old assets included a land worth 10 million. Okay, and now they've realized that this land is going to fetch 60 million in the market. This land is going to fetch 60 million in the market, but in their books, in their balance sheet, they are carrying that land only at 10 million. So they have engaged valuers. They have done the valuation and they have realized that its value is 60 million, but they are carrying in their balance sheet only at 10 million. So there is an increase of 50 million which they wanted to provide. Okay, so they are providing for that increase in value of land 50 million, additional 50 million. That's how we have the fixed asset of 150 million, which is basically the present 100 million plus increase on account of valuation 50 million. But whether this 50 million was realized in cash? No. It is the expected increase in value of asset which you will be able to encash when you sell the asset. Okay, so that's the understanding. But this business has no plans to sell the land. They are not going to sell it tomorrow. They are not going to sell it even after 1 year. They don't have any plans to sell, but they wanted to showcase they have so much of assets. So since they don't have any plans to sell that asset in near future, what is the point in doing this valuation? There is no point. But how the accounting treatment goes? You cannot have a lopsided accounting treatment, right? You cannot just increase the asset by 50 million. When you increase the asset side, that is when you increase the right hand side, you have to increase the left hand side also, only then the balance sheet will balance. So when the fixed asset was increased by 50 million on the left hand side, that is under equity and liability, the shareholders funds will also get increased by 50 million. Because under shareholder fund, we will have a head called reserves and surplus. Under that, there will be a head called revaluation reserve. Under that, this 50 million will be parked. Okay, so now try to visualize. On the fixed assets, the original value is 100 plus 50, so it is 150. So that additional 50 is also kept on the left hand side under shareholder funds with the heading revaluation reserve. Okay, but that money was not at all realized. So because of that reason, bankers adopt a very conservative approach. They will ignore that 50 million. They will ignore revaluation reserve. So that's what we are also going to do now. Even though we see shareholder funds has 200 million, since that includes 50 million of revaluation reserve, from this 200 million, we are going to deduct it. Okay, so point number 1. Number 2, look at the asset side. There is an investment in subsidiary of 50 million. So this money is not sitting in the present business. This 50 million has gone outside to subsidiary. So it is not sitting in this business, rather it has gone out to subsidiary. And subsidiaries are generally long-term investment which are not likely to come back. And our banking system also recognizes this fact that this money is not going to come back. So that will also be reduced from shareholders funds, 50 million. Then also have a look at goodwill. Goodwill is the intangible asset which they are carrying now. Probably this goodwill they would have accounted in their books when they have acquired some asset where they paid over and above its value. Okay, let's say they have acquired some particular company where they have paid over and above the value of that business. When they pay over and above what it is actually eligible for, that incremental portion we recognize it as goodwill, because that is going to give them additional revenues for the business. Okay, fine. Now this goodwill is an asset, is an intangible asset, but this goodwill will not fetch any cash when this business is collapsed. Follow me very closely. This goodwill of 50 million, okay, today value is 50 million. That's what captured in balance sheet. Assume this customer has defaulted the loan. Bankers are taking possession of assets, they are enforcing, they are selling each and every asset. They can sell current assets, they can sell fixed assets, all will have some value, it will give some cash flow so that loan outstandings can be reduced. But one asset will not fetch any value, that is goodwill, because already the goodwill of the business, the reputation of the business is lost, and that's why they have become an NPA. Okay, that's why that business is in NPA condition, and that's why bank is enforcing the assets. Okay, so the goodwill, which is an intangible asset, will not fetch any value at the time of realization. So bankers, on a conservative angle or conservative side, they will also deduct goodwill from shareholders' funds. So originally the shareholder funds what we have is 200 million, but of that we are deducting 3 items. So now what we have is adjusted shareholders funds. We call it as adjusted tangible net worth, and in this case it is only 50 million. We started with 200, but it has come down to 50 million. And please note, I'm using adjusted tangible net worth. We started with net worth, right? And this net worth figure, when it is adjusted for revaluation reserve and goodwill, we call it as tangible net worth, because these two items, this revaluation reserve and goodwill, are almost intangible. Okay, goodwill is absolutely intangible, revaluation reserve is only a book entry. So when we deduct these two items from net worth, we migrate to tangible net worth. And when we deduct this investment in subsidiary, we get adjusted tangible net worth. And some banks, they also deduct when investments are made in associate concern, and even if some long-term loans are given to subsidiary concerns or associate concerns or sister concerns, even that will be deducted by conservative bankers. Okay, now let us calculate this modified debt equity ratio. We know debt is 300. Okay, we'll take debt, that is TOL, in the numerator, and in the denominator, instead of net worth, we'll have adjusted tangible net worth. So 300 by 50, and the ratio is 6:1. So look at the difference. TOL by TNW, it is 1.5:1. Okay, it looks like a wonderful ratio, but if you want to see the real face of it, you have to go deeper, and here you can see TOL by adjusted TNW is 6:1. So most of the banks, they have this ratio as well. So they not only just look at TOL by TNW, they'll also see what is behind this. Okay, what is the reality, what is the exact face of this business, and that gets communicated through TOL by adjusted TNW. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. It is this Credit and Financial Analysis Mastery course, exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over, you also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. And not yet over, you're also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.